Crypto futures trading is one of the most powerful tools available to traders today. It allows you to trade price movements, use leverage, and even profit if the prices are falling. But with that power comes significant risk. In this video, we're going to break down what crypto futures trading is, how it works, and walk through real examples so that you can understand both the rewards and the risks. Before we talk about leverage and profits, let's clearly understand what a futures contract actually is. If you guys are interested in content like this, please subscribe to the channel to stay up to date. A futures contract is simply an agreement to buy or sell an asset at a specific price in the future. In traditional finance, futures were used for things like oil, gold, and agricultural products. For example, a farmer could agree today to sell his corn at a fixed price 3 months from now. That protects the farmer from unexpected price moves and allows the buyer to fix in a price. That's where the term futures originally came from. It's a contract based on a future price. In crypto though, futures are mainly used for speculation. You're not buying the actual Bitcoin. Instead, you're trading a contract that follows Bitcoin's price. If you think the price will rise, you open a long position. If you think the price will fall, you open a short position. Your profit or loss depends on how the price moves after you enter the trade. In simple terms, spot trading means you own the cryptocurrency. Futures trading means you trade its price movement. How does leverage work? Leverage is what makes futures especially powerful and risky. Imagine Bitcoin is trading at $50,000. You have $1,000 and believe the price will rise. Instead of buying $1,000 worth of Bitcoin, you open a futures position using 10x leverage. That means your $1,000 now controls a $10,000 position. If Bitcoin rises 10% from $50,000 to $55,000, a normal $1,000 spot trade would make you $100. But with a $10,000 leverage position, a 10% move equals $1,000. Your $1,000 becomes $2,000. That's a 100% return from a 10% market move. However, the downside works exactly the same. If Bitcoin drops 10% from $50,000 to $45,000, that 10% move against you wipes out your entire $1,000 position. Your position gets liquidated. Liquidation means the exchange automatically closes your trade because your losses have used up your margin. You don't owe additional money, but your capital for that trade is gone. That's how leverage amplifies your gains and your losses. So what is shorting? When you go long, you buy first and hope to sell later at a higher price. That's intuitive. When you go short, you sell first and plan to buy back at a lower price. Effectively, the exchange lends you the Bitcoin so that you can sell it, but you need to buy it back and give it back to them at a future date. For example, if you short Bitcoin at $50,000 and it drops 10% to $45,000, you earn $5,000. Binance lent you one Bitcoin, you've sold it in the market, received $50,000. Then a couple months later, you have to give Binance their Bitcoin back. So you buy it back on the market for $45,000. The difference is your profit. But if Bitcoin rises 10% to $55,000 instead, you lose $5,000. The mechanics are simple. Sell first, buy back later. You profit if the price falls, and you lose if the price rises. Futures trading allows you to trade in both directions, use capital more efficiently, and lever up. But flexibility increases risk. Professional traders focus on managing their downside risks. They use smaller position sizes and avoid excessive leverage. In leverage trading, survival is more important than fast profits. If you're new, don't use leverage. Leverage should only be used if you're an experienced trader. If you are a beginner, educate yourself first. You can have a look at the Binance Academy. They have incredible resources to learn. And guys, never trade what you can't afford to lose. I hope this video helped you guys understand futures a little better. We'll see you in the next one.